reach the stars. Now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
Good morning, everyone, and welcome to the 2022 edition of our Economic and Market Outlook discussion titled Beyond Clangs and Chatter, Going for Gains, where we'll discuss how best to navigate the noisy environment. For our new audience, Meristem Securities, as a company with a brand promise of providing up-to-date market information timely, holds this event at the beginning of every year to provide our view on the expected direction of the economy and to guide our investment activities. My name is Cassandra Romosele. I work at Meristem Securities as a fixed income dealer. We'll have contribution, and I'll be the moderator of this session. We'll have contributions from 5 panelists, consisting of 2 guest panelists and 3 members of our research team. Allow me to introduce the first panelist, Dr. Franklin Ugu. Dr. Franklin Ugu holds a PhD in Law and Economics of Banking Regulation, an MSc in Economics and Postgraduate Diploma in Development Economics from the University of Manchester, UK. In addition, he also has an MSc in Comparative Political Economy from Cardiff University, UK, and a BSc in Sociology from the University of Lagos, Nigeria. He has over 15 years of experience in teaching, private sector, policy research, and consulting, both in Nigeria and the UK. He has consulted for both local and international organizations and worked in Barclays Bank UK for over 5 years. He has lectured at Glasgow School of Business and Society, Glasgow Caledonian University, School of Built Environment and Business, University of Salford, Department of Economics and School of Law, University of Manchester, UK. He is also a member of several bodies, including the Society of Corporate Governance Nigeria, British Academy of Management and Risk Managers Association of Nigeria, RIMAN. Dr. Franklin Ugu is a faculty member, Lagos Business School, and the director of the LBS Sustainability Center. Our second guest panelist is Dr. Oluseye Olushoga. Mr. Oluseye Olushoga, apologies. Mr. Oluseye Olushoga is the pioneer managing director of Persian Partners Limited, Nigeria's foremost indigenous interdealer brokerage firm. He has previously worked at Lehman Brothers London in the debt capital market before moving to Citibank as a trader within its Citigroup Global Markets in London. He played several roles during his time at Citi trading commodities, FX rates, and credit before taking on leadership roles within the derivatives market space as the head of European credit options and index team. Mr. Olushoga holds a first-class degree in electronic engineering from the University of Surrey and is an alumnus of the Said Business School, Oxford, and Warwick Business School in the UK. He is also an alumnus of Lagos Business School and was a member of the Capital Market Master Plan Committee. Our third panelist, Ahmed Jinad, is the head of investment research at Meristem Securities Limited. He possesses strong quantitative financial modeling and analytical competence and is proficient in business strategy, financial markets, and risk management. Before joining Meristem, he worked as a project analyst in the Commercial Agricultural Development Program of Lagos State Government. He holds a Master of Science as well as a bachelor's degree in agricultural economics from University of Ibadan. Our fourth panelist is Seun Arambada. Seun holds a Bachelor of Science degree in economics from the Obafemi Awolowo University, Ile-Ife, and he's currently studying for a master's degree in the same discipline at the University of Lagos. At Meristem, he maintains equity research coverage over Nigeria's industrial goods sector and leads the macroeconomic research desk. In the course of his career, Sheung has also co-authored research papers that featured in the African Journal of Economic Review and in the IFE Journal of Economics and Finance. Our fifth panelist is Kelechi Chidi Ihoma. Kelechi Chidi Ihoma is a research analyst at Meristem, covering the energy sector. She has a background in agricultural and environmental engineering from the University of Ibadan and is a graduate member of the Nigerian Society of Engineers and the Society of Petroleum Engineers. She enjoys volunteering and is part of the volunteers for the annual Global Open Mathematics Tournament organized by the Mathematics for Life Foundation. Thank you all for joining and honoring us with your presence. We will take the presentation by Sheung and Kelechi. While this presentation is going on, kindly drop your questions, comments, contributions in the Q&A chat box. We encourage everyone to please drop your questions and comments in the chat box. We'll get the ball rolling with the presentation by Kelechi and Sheung. Hi, Sheung and Kelechi. You can take over now.
Thank you, Cassandra, for that wonderful introduction. Welcome everyone to Meristem 2022 Annual Outlook, tagged Beyond Clangs and Chatter, Going for Gains. So our outlook touches on the various macroeconomic events that have played out in both the global and the domestic economy. And what we have done is to see beyond the uncertainties and fears that have happened and pick out potential gains that we would likely see in 2022. So starting off, sorry, I think my screen hanging at the moment. Okay, so starting off, I would take the global economy, and my colleague Sheung would walk us through the domestic economy down to the market. So the global economy. A quick review of the vaccination progress that has played out last year. From the data we see, the advanced economy have really, had significant improvement in vaccination rates. From the data, we see that vaccination rates have improved by more than 50% in advanced countries. But then when we compare to Africa, vaccination rate is still below 10%. And what that tells us is that there's still an uneven distribution of vaccines across the board. And the advantages that this advanced markets have is that strong fiscal infrastructure, which has helped to mitigate the logistic challenges. But then when we we come down to the middle and the low income countries, we see that this logistic challenges have been intensified. And now that there's an emergence of new variants, that's the Omicron and the Delta variant, which according to data spreads even faster than the earlier variants. There's a need for, some pharmaceuticals have come out to say that there's a need for a booster shot to improve immunity against this new variant. But then looking at global statistics, we see that more than 90% of the population are yet to receive this booster. So it tells us that there's still a long way for us to go. And while some countries have said that they would intensify their efforts to make sure that this booster shot is administered to their citizens, the pace at which this plays out this year would really tell on how things evolve in 2022. So on this note, we have summarized the global outlook. We looked at macroeconomic indicators and we have put up a summary. So starting with the world GDP, we saw last year global output was expanded by 5.88%, and most economies, both developing and developed countries recorded an increase in output, even higher than pre-pandemic levels. And this was owing to improved demand for goods and services. Also, favorable monetary and fiscal measures that was put in place last year. And this year, IMF projects a moderation in that growth. And we see some countries like China still recording a slow pace in growth. And we saw their PMI, and we saw their PMI index fall below 50 points in November last year. And that was the first time since February 2020 when they had a very strict lockdown due to the virus spread. And so, I mean, the country has been struggling to sustain their output growth. And we also see the US too recording a slow pace in growth towards the tail end of last year. And this is owing to the supply bottleneck and also higher energy prices that is impacting production. So on this note, just recently, IMF had to review, I mean, these are major economies, US and China. So on that note, IMF had to review their forecast, their GDP forecast for 2022, and they revised it from 4.89, which they projected in September, now to 4.4% last week. So moving to the global inflation, inflation has moved higher than many central banks targets. The US recorded a 7% increase in inflation rate in December 2021, and this is way above their benchmark. And while earlier in the year last year, we saw, most of the authorities mentioned that these factors were transitory. That's the case of the supply bottlenecks as well as higher energy prices. This was thought to be transitory, but then we saw towards the tail end of last year, prices still, stayed elevated. On that note, global inflation rose to 4.35% year on year last year. But then in 2022, projections are that inflation rates would moderate to 3.81%, and this is on the back of most of these factors phasing out. I mean, we see and we expect an improvement in global trade, and we expect also energy prices to tone down during the year. So based on that, inflation rate would moderate, in 2022. So for the fiscal deficit to GDP ratio, we saw that, compared to last year's 2020 and 2021, most fiscal authorities had to increase spending in order to curb the virus spread and also to boost demand in their economies. But then for 2022, we see that to moderate. The global economy has maintained some sort of stability, and because of that, we still see the fiscal authorities still, holding that accommodative stance. But then we feel like we expect spending to be lesser in 2022 compared to the last 2 years. So the concessions that we saw last year, tax concessions, as well as the high stimulus injections, which will likely to moderate this year. So that in turn would reduce the fiscal deficit to GDP ratio to 5.19%. In terms of the oil market, so for us, we see prices, oil prices to average, Brent crude prices to average around $87 per barrel. Now, this is due to, we feel like we expect fast inventory drawdown. Demand has improved. Demand for petroleum products have improved significantly, and that will lead to fast inventory drawdown. Also, looking at the OPEC side, we saw the pandemic induced quota, attached in 2020, and OPEC has come to say that by May 2022, that pandemic induced quota would phase out. And nevertheless, if we look at actual supply, really, especially from the African counterparts, Nigeria, Angola, production volumes have been very poor. And even though OPEC is likely to phase out this pandemic-induced a restriction on production, we do not see performance, especially from the African counterpart, to improve significantly. So we see supply still stay moderated. So on that note, we have summed up we've analyzed these factors, and we expect prices to average around $87 per barrel. For the monetary policy, we feel the authorities would adopt a hawkish stance, and this is on the back of the high inflation figures that we are seeing. Bank of England has increased rates in 2021. The US is talking about increasing rates 3 times this year, and also reducing the asset purchase program. We also saw the European Central Bank also tone down on their pandemic asset purchase program. So it is more of a hawkish stance from most of the monetary authorities this year. So we expect inflation rate to moderate based on this. And so this shows, from the chart, we can see that global growth trajectory would tend to tone down in 2022 going forward, similarly to inflation, as well as fiscal deficit to GDP ratio. So I would call on my colleague Sheun, who would walk us through the domestic economy.
We cannot hear you, Sheun. Please check your mic again. We still cannot hear you.
Okay, can you confirm you can hear me now?
Yes, we can.
Okay, great. Okay, so you will remember that at the start of 2021, the song on everyone's lips was the fact that 2021 was a year of recovery from the pandemic shock, and rightly so. If you look at GDP numbers, at least for 9 months into 2021, you'll see that GDP has recovered significantly. At least when you compare it to what we had before the pandemic, at least output level is better by about 0. But looking at the component drivers of growth, we can't take it away that the non-oil sector has been the major driver of growth. Given the challenges we've seen with the oil economy, right? Oil output is still lagging the quota. Considering the oversupply we've had in previous years, oversupply now in terms of comparison to the quotas put in place by OPEC. In recent times, Nigeria's production has lagged the OPEC quota, and this is one of the things that has contributed to the underwhelming performance of this sector, not minding the fact that oil prices have been supportive for the most part. But then if you look at the non-oil sector and looking deeper at the factors that have contributed to the growth, I don't think it would be surprising to see that trade, ICT, and agriculture and manufacturing as well have been the major factors that, or the major components that has contributed to that growth. For trade, it's also not surprising, given that when the pandemic hit, one thing it did to the economy, was to affect the external sector majorly. You saw significant drop in oil prices, lockdown with in trade, in the economies of trade partners and all of that. So that really impacted the economy. But coming into 2021, we've seen a lot of that ease, and trade is better for it. ICT, we've seen an increase in subscriber base of telecom players, right? With the increased adoption of teleconferencing and the like, it has meant a huge, a huge gain for data revenue for telecom players. So when you combine all of that, it shows the improvements that we're having in that space. For agriculture and manufacturing, these are sectors that have benefited immensely from the support of the central bank, special interventions, to the agri sector, and credits really to the private sector has supported the manufacturing sector. If you look at PMI statistics, majorly for November and December, you see that it's inch above the 50-point mark, compared to what we had for the most part of the year. But for the agri sector, we can't take it away that the challenges still remain, and that sector is yet to live up to its potential. For what we expect in 2022, we consider insecurity and some political tensions that may arise, and how this can affect agricultural outputs. Most of what I've said in the previous slide also are summarized here. Key downside for ICT is the STEM regulatory environment. We saw that play out in the first quarter of 2021, where we saw a slight drop in subscriber base, but I think that has since improved, and we expect that to continue to improve, except we see another regulatory shock on that end. But I think the ICT will continue to be a key contributor to growth. For agri and manufacturing, really, we expect that the government support will continue to reflect in the performance of that sector. But for manufacturing particularly, we are considering the problem of FX liquidity and how that is going to impact manufacturers. This is a challenge that has persisted for a while, and for us in our model, we consider it to still remain a key headwind to growth in that sector. For mining and quarrying, we are looking at the divestment that is happening, especially around in the oil economy, and acquisition of those assets, right? We're also looking at what the Petroleum Industry Act will mean for the oil sector in general. We are watching that space closely, but for our model, these are things that we've considered as key tailwinds to growth. All right, so I think our expectation is summed up in this slide. I think let me put the spotlight now on insecurity. Insecurity is something that has, significantly weakened the investment case of Nigeria as an economy. And for us, we're looking at 2022 being a pre-election year. We do not rule out some pockets of violence here and there, especially in the nation's food belt, right? We think this is going to affect agricultural outputs, like I mentioned earlier. And also it might lead to a situation whereby we will not see an influx of the much needed FDI. I should also mention the impact of inflation and how it impacts on consumer wallets, right? Our expectation for inflation going into 2022, we expect it to average 15.20%. I'll be speaking to that in subsequent slides. But even at that level, we think that inflation is still elevated, and its impact on consumer wallets will still be dire. I mean, compared to acceptable thresholds of about 6 to 9%, having an inflation expectation of 15.20 for the year, I think that is still high. So we are looking at this from a demand perspective. This could shrink private consumption, and that could also affect GDP as a whole. So overall, we expect GDP for 2022 to grow by 2.51%. All right. I think inflation is one economic indicator that I think deserves special attention, especially given what it means for markets and investors generally. Like I mentioned earlier, we expect inflation to average 15.20% in 2022. Well, this is slightly moderate when you compare it to an average of 16.98% that we had in 2021, right? But looking at the factors that we expect to drive inflation, now speaking to food inflation, I already mentioned that we do not rule out cases of unrest in certain parts, which could possibly mean that farmers are not able to go to farm as they would, and which would affect output. For 2022, we are looking at a situation whereby agri sector will benefit from favorable weather conditions. I mean, that's one key tailwind that we cannot take away. But for core inflation, I think there will still be that element of exchange rate pass-through to inflation. But on the other hand, we're also looking at how the Petroleum Industry Act, especially downstream deregulation of the oil sector, although new information coming during the course of the week, the finance minister saying we shouldn't expect the removal of fuel subsidy as earlier thought. Well, I think if this is followed through and through, I mean, it means well for inflation, and we might not see an unusual spike in inflation numbers. But regardless, looking at all the factors and on the balance of factors, we think that the risks are still tilted to the upside. Okay, so I've spoken to that. Looking at what the fiscal policy direction would be for the country in the coming year, I think it's more or less the nation dancing to a different dance really to the same tune that we've had over the years, right? We are saying, but this time, I mean, we are seeing record levels of expenditure, and we have modeled that in our expectation for GDP, right? We are saying that we expect to see significant expenditure from the government. But looking at what we have in terms of fiscal deficits, we have about 6 trillion in fiscal deficits, which is to be financed. 80% of that will be financed by debt, and the rest will be by asset sales and project-tied loans. But looking at the fiscal policy trust of the government in the medium term, as stated in the National Development Plan, at the heart of that plan is fiscal consolidation. That is, the government is seeking to reduce fiscal deficits as a percentage of GDP over the period. And I think that is well on course. Looking at what we have in terms of fiscal deficits to GDP currently compared to what we had last year. Okay, so the external sector, I spoke to the external sector earlier and how the pandemic dealt a major blow to the external sector. And I think for us in Nigeria, this is something we pay particular attention to because of its importance on exchange rate and what it means from a welfare perspective. But I think it's important to highlight that at the very core of the exchange rates challenges, we should look at it from a very fundamental part, and we can only speak to that from a current account perspective. So from the slide, you'll see that current account has been deep in the negative. Current account balance has been deep in the negative region over the past few quarters. Although we've begun to see that deficits moderate, which is also partly due to the recovery in oil prices. But on the other hand, remember the fact that we are not producing as much as we should is also reducing, or should I say, it caps the potential of the current account balance to come out of the negative region soon enough. As a matter of fact, our outlook, we think that this current account deficit is still going to persist in 2022. Because of the deficit we have over the years, of course, we know that the CBN plays a major role in the FX market. And speaking to the CBN's ability to continue to support the naira, in 2021, oil prices and one of FX inflows were supportive of the external reserve. From the chart, you'll see that spike, around September, and we attribute that to the SDR drawdown and also the Eurobond issuance that we saw around that period. But for the most part, we also agree that oil prices were supportive. But for our expectation in 2022, we try to discount expectations of those one-off inflows, and we are looking at a situation where, in the absence of those one-off inflows, accretion to the external reserve might not be as significant as we might think. So our outlook for accretion to external reserve is moderate. In the next slide, we'll see what that means for the exchange rate. So based on this myriad of factors that we see that will play out in the external sector, we have created a case, a scenario for our expectation for exchange rates. And at the base case, we have that for the year, exchange rate should average around 435.66 to the US dollar. And the major factors that we highlighted are higher oil prices, or like I said, production shortfall should still persist. We are looking at a situation whereby FX accretion to the external reserve would moderate and should probably signal less intervention by the CBN. We also expect that current account deficits will remain wide, and also possibilities of capital flow reversals ahead of the general election. I think this is something that would agree to because of the high pacing that comes with election years. We might not see the kind of inflow, if at all, because of the risks that is associated with our own economy. We might see some level of capital flight. Looking at the other extreme, at the very bear case, we expect exchange rate to over around 470 to 500, and we're looking at a worst case scenario of having another shock to the global market for crude oil, probably if the new variants of COVID are not well contained, and trade partners begin to begin to go into lockdowns again, and energy demand drops. We're also seeing current account widening and capital flow reversal. So at the very worst case, this is what we expect. But at best, we expect that exchange rate should be around 4.43 to the dollar. Okay, so having laid the foundation, the macro foundation for what we expect, I think it's important to see how funds were allocated and what we expect for fund allocation. So I was speaking to market, speaking to the equities market. I think we'll remember how the markets returned about 50% at the end of 2020, and coming into 2021, the bulls still dominated the market, in the early part of the year. Still saw that positive momentum continue in the markets, but towards February, we saw that momentum drop and really continue for the most part of the first half. And by the end of the first half of the year, the markets closed on a negative note. But I think the tide changed in the second half, and this was due to investors' reaction to positive earnings releases. We also saw some corporate actions, which also spurred investors' interest in large cap stocks. And at the end of the year, the markets closed on a positive note, closing up 6.07% on the year. For our expectation in 2022, we think that the market will also be influenced by a myriad of factors. But before I speak to the outlook for the market, I think it's just important to see how the markets perform on a sectoral basis. I think the oil and gas sector stood out from the fact, returning about 53% on the year. Every other index closed in the positive as well, except the industrial goods index. We can attribute that to the sell-offs we saw on Boa Cement as well, right? So for the oil and gas sector, we cannot take it away that the improvements in oil prices also contributed to the positive sentiment on oil and gas stocks. For our expectation, we expect periodic round of sell-offs in the market, of course. But I think a major thing we should also highlight, and most people will be expecting, is the fact that how will the markets perform, given that 2022 is a pre-election year. And if you look at history, there's history to back that up, that almost anybody will say, it's a given for us to see an extended period of sell-off. But we are bringing an exception to this case. Look, the market dynamic this time is not exactly the same. Domestic participants take the chunk of the market. Coming from COVID, and we're looking at domestic participation at about 77%. So given this dynamic, we do not expect that we'll see as much sell-offs as we'll see. We can't take it out that investors will react to rates, but probably not as much as you would expect. We're also looking at fixed income yields, probably something similar like what happened in 2021. If there is a change in the yield environment, we could see funds pivot towards less risky fixed income assets. We also think that companies would react to positive earnings releases and corporate actions. Already in the year, we've seen how investors reacted to the share buyback by Dangote Cement. And also, we think that investors are going to cherry pick for stocks that present attractive dividend yields. So for what we think in terms of how investors should approach the market, our strategy, we prefer defensive and quality good stocks, to mitigate against this volatility I spoke to. And of course, we'll always put forward high dividend yield stocks that have strong fundamentals. For our expectation in the fixed income market, looking at advanced market, I think it's safe to say that if we're going to summarize how the market performed in advanced market, I think it's safe to say that risk trended upwards. Although on a case by case basis, we will see differences, but we saw mild and moderate volatility. Particularly when you look at UK gilts and US Treasury. But I think a dominant theme is the fact that investors are requiring higher rates, given where inflation is hovering around in advanced markets. Kelechi earlier spoke to us seeing inflation at about 7% in the United States, almost at levels never seen before, way above the US Fed's threshold of about 2%. Of course, we know that what this means is that investors will be requiring higher rates for their investment to compensate for the loss due to inflation. But looking at emerging markets, I think the reverse was the case, because funds pivoted towards this market from investors in search of higher yield. So there was that demand for emerging market instruments, and that sort of led to a moderation in rates in advanced markets. So for the Nigerian market, I think the Nigerian market bucked the trend in 2021. I mentioned earlier the fact that there was like a change in the interest rate environment starting out the year, but for the most part, it's been hovering around the same level. But towards the end of the year, we began to see drop in rates, especially on the 364-day instrument. For our projection into 2022 and where we see rates, really, I think it's a dicey one to call, and the reason is due to several factors, really. One of which is the lack of clear policy guidance as to the country's fiscal policy direction, right? And also the conflicting policy objective of having to manage the government's cost of debt and also to compensate investors for their investment, right? So it's highly uncertain, and of course, this uncertainty, has helped us in drafting our strategy, which I'll be speaking to in subsequent slides. But for our expectation, really, we're looking at existing issues, really, currency rates persisting, inflationary pressure. I spoke to inflation averaging 15.20% in 2022, and we also, in our models, we factored the effect of political risk. We think that monetary policy in 2022, we did not see a compelling case really for a hike in rates by the MPC. From the meeting that we had yesterday, I think this is well in order, where the MPC voted to retain all parameters at current level. So based on our expectation for the fixed income market, our strategy to navigate that space will be the barbell strategy, where we profile that investors should take positions at both extremes of the yield curve on a 50-50 basis, right? Because of the uncertainty with the interest rate direction. So whichever way the interest rate swings, our clients can make the most of that. Okay, briefly, I'll be speaking to alternative investments, and that will wrap it up from my presentation this morning. All right, so commodities really has been bullish. Since the recovery from the pandemic took effect. Case in point, you look at what we've been saying with oil. Oil prices have moved from the lows we saw in the second quarter of 2020, to rising to the USD 70 level. Also, this is also replicated across other commodities. You look at the rise in the prices of agricultural commodities, cereals, and the like. So, we still expect that this momentum will continue, given the level of liquidity globally, which we think is what is driving this momentum. But looking at rates, I think the reality for rates, real estate investments in advanced markets is quite different from what we are experiencing domestically. Global rates returned about 28%, but on the domestic front, we are seeing a negative return. We cannot isolate the fact that the risks associated with real estate investments, concerns as to title ownership and transfer of land is something that has been, hindering the potential of that sector. But generally, like I said, for commodities as well, the level of liquidity globally should still support the momentum in that space. I think that will wrap it up. At this point, we can have our panel tell us what we can expect as well.
Thank you for the presentation, Kelechi and Seun. It was insightful and a lot was said. We'll move on to the guest panelists to get their views and their contribution. I'd like to start with Dr. Franklin Ugu. Sir, from the presentation, supply chain constraints are still expected to dominate economic discourse in 2022. Please share your thoughts on this, and do you think a resolution is in sight? Also, would like to know what sectors you are positive about for the year 2020.
Okay, thank you, Cassandra, and thank you to the two presenters. Very detailed, very insightful, a very clear guide in terms of how we're going to perform in 2022. With regards to the question, of course, the supply challenges are there. Of course, when you want to do economic policies or when you want to pursue economic development, there are three clear policy directions you have to look into. One is the monetary policy, which the central bank handles. And the second one is the fiscal policy, and then the supply side policies. But what has happened in Nigeria is that most of the time, we seem to ignore the supply side policies and focus more on the fiscal policies and the monetary policies. But even more recently, I think the focus has been more on the monetary policies in terms of what the CBN is doing. But of course, that's why CBN is, some people are arguing that CBN is, in addition to monetary policies, they are also intervening in the economy in almost in all the different sectors, agriculture, real estate, and all that. So the supply side policy or supply challenges is a big issue in Nigeria. And so a typical example is that we're all looking at food inflation is going up and all that. But the question is, what are we doing to ensure that the farmers return to the farms in terms of insecurity? Of course, the government has been trying to see how they can reduce the insecurity that we have in the country. But of course, it remains a very, very big threat and a very, very big challenge. So if we don't address some of these issues, there is no way the farmers can return to the farms. And of course, there is no way the supply will increase. In addition to that, if we look at agriculture, I'm just using agriculture and food as a case study. So if we look at what they produce, another challenge is how do they evacuate it from the farms to the market? That is, it will still remain fresh, it will still be okay for consumption. So we find out that a significant quantity of what we produce, that we lose them in terms of moving from the farm to the market. And so the supply challenges remain, is a very big issue. And the next question is, do we have solution to them? It is neither here nor there, in the sense, as I said, the government is trying to address the issues of insecurity. I'm just looking at two examples because of, so other panel members can also add to that. So if we look at the issue of insecurity, the government is said that they are trying their best, they're trying to see what they can do. But are we really seeing significant, clear decline in insecurity? The answer is not really positive, in the sense that on daily basis, of course, we heard what happened in Ogun State, what happened in Imo State, what happened in the north, or what happens in the north regularly. So it's more or less a very recurrent and it's more like continuous. So it's a big issue. And also the issue of evacuation as well is also a big issue as well. So I'm not sure that we can say that we have a clear solution or a clear resolution in sight, even though efforts have been made to address some of these issues. But it will be appreciated if the government can double the efforts, and if also they can see ways they can partner with the private sector and other stakeholders to address these supply side challenges. Because if we don't do it, inflation, which we hope will be tamed this year, will definitely go up based on the demand for food. As long as population growth is there, the demand for food will be there. And as long as the supply cannot meet up the demand, inflation will definitely come in again. So I cannot say that a solution is in sight, even though we appreciate, we commend the efforts being made to address some of these issues. Thank you.
Okay, sir. Thank you very much. Just to follow up, what sectors of the economy are you positive about for this year?
Sorry, I forgot that one. So there are a few few sectors that we can call growth drivers, which we believe and think that they need more support and through which other sectors can be lifted as well. So number one will be the financial services. Number two will be agriculture. Number three will be telecommunications. Number four will be manufacturing. And number five will be construction. So there are other sectors that are showing signs of coming up. However, I believe that these 5 or 6 sectors are what we can call the growth drivers of the economy. And hopefully, with the way they are going, and in addition to digitization of technology that will now help these sectors to grow better, I believe that other sectors can also be lifted. So financial sector, of course, we know is like the fulcrum upon which everything depends. The same thing with telecommunications, the same thing with agriculture in terms of food. Construction is going on, real estate, road construction, all kinds of construction are going on. And manufacturing, of course, particularly when we talk about manufacturing, we are looking at those that are manufacturing, that is fast-moving commodity goods, that are manufacturing things that we need, that we consume on daily basis. So those ones we cannot do without them. So they will definitely experience positive economic growth. But I also believe that the economy will generally do, other sectors will also do a lot better than they did in 2021, given few factors that we've also mentioned. There will be more diaspora remittances. There will be more money in circulation because we are moving into election year. The other economic sectors will also grow, which of course there will be cyclic impact on the economy. And of course, we should have a better 2022 than 2021. Thank you.
Okay, thank you, sir. So I'll move on to the second guest panelist, Mr. Oluseyi Olusoka. So recently we received the news of the postponement of the fuel subsidy, and the finance minister stated that it wasn't provided for the second half of the year in the budget. So I just wanted to get your view on the impact of that in the fixed income market, knowing that if that were to be included in the revised budget, definitely we're expected to see like an expansion of the deficit figures. So can you please give us your view on how you think that will impact the markets?
I mean, it's a very interesting question. I think that looking into Q2, Q3, I expect yields to go up just simply because I would expect the government would have to borrow a lot more money than they previously anticipated. So I think there might even be a revision to the calendar in terms of how they plan to borrow and raise money. But still also given the fact that if there's less money, giving NNPC's contribution to the FAC allocation would reduce significantly. And if oil prices continues to trend up, then obviously the subsidy amount would trend up in line. And so there's going to be less money for states and less money for everybody, really. So I think that inflation should continue to trend upwards. I think that given where Eurobonds are currently trading, and particularly with the expectation that rates are going to be increased by the Fed, I expect that most emerging market bonds would actually, the yields on those would actually trend upwards. So I think it will make a lot more sense for the government to borrow a lot more local currency bonds. And given that, I expect that yields will trend upward in Q2, Q3 of 2022.
Thank you very much, Mr. Oluseyi. So Ahmed, I would like for you to contribute to, from the presentation, a bit was the US stock market was touched on a bit. So currently we're seeing stock prices decline in the US. So should we expect this to filter into the Nigerian market too?
Thank you, Cassandra. Not really. If you look at the drivers of the sell-offs that we're seeing in the US market now compared to our markets, then the forces are not exactly the same. In the US market, like Sean said in his presentation, the mood of monetary policy suggests that things will be tighter in 2022. And of course, already it means that a lot of investors are reallocating assets to less risky assets like the treasury instruments and bonds. So, and what that also means is that you're going to have less injections into the economy compared to the last 2 years, basically because of the pandemic. And what that all that's the implication for the equities market in the US then is because it's a market where you have a lot of leverage positions. It also means those who are funding positions via margins will also be at risk. And so, to mitigate some of the risk that comes from that perspective, you can understand why you're getting some of those sell-offs. And then you also look at the assumptions behind the tech stocks, especially in the wake of the pandemic and expectations that everything's going to be digital. And so we expect the growth forecast for many of those companies are not panning out. Initially, they were robust, but they're slowing down. All of that are the reasons behind the current sell-offs that we are seeing on US equities. Those factors apply to the Nigerian market in the same manner and to the same extent? The answer is no, it doesn't. While you can draw parallels, that's okay, like Mr. Olusha said in his presentation, and like we've also seen in the market in the past 2 years, there's a strong relationship between yields in debt markets as well as equities performance. So obviously for us, what we need to be watching is yields in the Nigerian market. And if you take a cue from what the CBN governor was saying yesterday, monetary policy in Nigeria will continue to be supportive, in contrast to the hawkish stance that we expect in the advanced markets like the US and UK already started in December. So, the dynamics are not exactly the same. So I don't think that we should take a cue from what's going on in the US market currently.
All right. Thank you, Ahmed, for that. So we know this is a pre-election year, and major things happen the year before elections. So, Dr. Franklin Ugu, on the domestic front, to what extent do you expect the electoral campaigns ahead of next year's election to impact growth and inflation of the economy?
We already seen many people declaring that they want to contest different posts, presidency, governorship, and all that. So expectedly, we will see more people coming out. And they also, of course, the two major parties, they also have their conventions and primaries very soon, and other parties. So, of course, as we move into quarter two, the activities will pick up very, very well. And definitely, once this starts, money circulation will increase, which, to the ordinary Nigerians, is positive in the sense that this money will be shared and they will have more disposable income. They will hire flights, they will hire buses, they will hire venues, they will cook, they will distribute rice, and all that. So in my local government, one of the candidates that is contesting for local government and for the chairman of the local government distributed rice over the Christmas, over 200 bags of rice. So that now goes to the market women, and of course that goes to the widows. So in summary, the election year that we're entering will have both positive and negative impacts on the economy, in the sense that the money circulation will increase. So the ordinary Nigerians is positive, but however, it might also contribute to the inflationary pressures that we're going to experience. So that's basically with regard to the election year. But of course, also there's also another negative impact that it might have, in the sense that once we move into the second quarter, third quarter, some of the ministers, some of the key policymakers might likely, some of them that are interested in contesting the elections might likely resign. They might likely maybe focus more on election. And those that are not resigning might also be more interested in ensuring that their candidates win. So there might be a kind of, they might not pay proper attention to economic development or policies that will drive economic development that they're supposed to do because of their interest in election. And of course, also many people will be saying that the PMB, the governors that are more or less going, so the attention will not be with them, but maybe to the people that they believe that will win the election. So those are some of the negatives and the positives that we're going to experience with regards to the election going into 2022.
Okay, thank you very much, sir. My next question is for Mr. Olusheye. But before I ask, I would like to ask everyone to fill out the Google form. The link has been dropped in the chat box. Please use Google Chrome to open the link to enable you fill the form. Thank you very much. Hi, Mr. Olusheye.
Hi.
So, hi. So we have a question in the chat box from one of our attendees. The question is, what is the impact of the Fed rate hikes on FDIs? Then just to add to that question, would like to hear your views on what we should expect with FX this year. Do you see more devaluation of the Naira this year?
Okay, so the first question about Fed rate hikes and FDIs, I just think that FDIs require a lot more for their money. So meaning that if you want those guys to come into Nigeria, you have to raise your interest rates. It has to be attractive enough to justify why they should invest in your country to attract them. And also whatever investments that they would want, they require a lot more return on investment. So the era of free money would be significantly, or is pretty much coming to an end in the US, because I mean, the talks of between 5 to 7 rate hikes over the next 18 months. So whether that's going to come into play or not, we don't really know. Whether the inflation that they're seeing, which is at its 30-year high, is here to stay, or things are going to calm down over the next 6 to 12 months. So to your question about FDIs, I think that they'll, it should reduce the pace at which they come, and those that come would want a higher return for their money. So the question around FX, it's an election year. So whilst the economic theory and all the things we learned in school suggest that given all the things that are happening, there should be further devaluation, I'm actually neutral. I don't think that you would have a significant devaluation in 2022 from where we currently are, just simply because it's an election year. So I think that the levers of power, our central bank is not particularly independent of government, in my view. So I think that they will do whatever it takes to minimize any devaluation impact on the official, through the official channels. I also think that given the gas supply chain issues that you have around in Europe, I think that energy prices will remain elevated, and that would support high or elevated oil prices, at least for the first half of 2022. So when you put all of those things together, I think that I don't expect significant devaluation in the Naira. So that's the list of the worries. Now, what then happens post the election is a significant different conversation. So FX is the list of the concerns. I think you're more concerned about inflation, cost of living, in the country, more things that you worry about. Even the Fed rate hike for me, as a Nigerian living in Nigeria, is inconsequential. They're complaining about, whether it's half a basis point or 1% is where their interest rate is. That is already, at significantly elevated levels. So for me, I think that FX is the list of the worries. Inflation is more of a concern, and cost of living and security. Those are more of the things that I think would drive whatever is happening in Nigeria in 2022.
Okay, thank you very much, Mr. Olusheye. So just to piggyback to the first question with regards to your view on yields, do you have like a range of where you think rates would peak at? And also another question is, we do not have so much foreign players in the market right now. So do you think the government has more power to manage yields or you think the market will be able to push the hand of the government with regards to yields increase?
I think that it's a PFA and CBN controlled environment, in my own view. I think that even if rates go up in Nigeria, I don't think you're going to see anything above 300 basis points, if at all you get that, because I think the DMO is a lot more sophisticated in playing games with our prices in terms of where yields cut off and stuff like that. So there are a lot of ways that which you can, ensure that rates remain at, within controlled bands or levels. But again, I don't like guessing on, how high or, these things will go. My view is that they will go high. I would say 200, 300 basis points max. But, I don't expect anything aggressive because I think that it's going to be a lot controlled. And also with the foreign investors, right, you're now competing with a lot of things, a lot of factors. I mean, when you look at Ghana Eurobonds today are trading on average at 13%, and that's a dollar asset. So if I'm getting a dollar without the FX risk, 13%, return, the incentive to go and take a Naira asset at 14% is not that attractive, to be honest with you. And, if I was also the central bank governor, how desperate am I to collect that money? Would I really want to push it that high? So I'll maybe focus on more developmental financing or cheaper alternative sources of getting access to dollars and things like that, as opposed to trying to push interest rates to 16 or 17%. It makes no sense, even though technically that's where it should be. But if I was the central bank governor in an election year, if I want to keep my job, between myself and the DMO, DG, I don't think it's something I'll do. So I would like to put myself in their shoes and forget the logic that they taught us in school, because sometimes Nigeria has taught me that theory is not necessarily what drives the Nigeria market. And I think that we just need to put ourselves in their shoes. So to your question, I think for me, I don't think more than 200 to 300 basis points hike increase in rates. I think that it's a local play. And I think that looking for the offshore guys to come in is like chasing after shadows, to be honest with you. So that's my own take.
All right, thank you for that. That was quite explanatory and insightful. So I would like to call on Seun. Seun, so my question for Seun is, what other risks are likely to impact global growth this year? Hi, Seun. Yeah, I'm muted. Okay, it seems like Seun is having a technical issue. So we would move on to another question in the Q&A chat box. So I have a question from Junila Takon. The question is, do you think pension funds is at risk considering the recent news that government wants to borrow from the fund? Can Mr. Olusheye, can you speak to that?
I don't think the pension funds are at risk. I mean, everybody says, when people ask these kind of questions, it's the federal government of Nigeria that is borrowing the money. So if there's a problem, they'll print more Naira. The question is, what's the value of your money? But would the pension funds exist? Of course they would exist. It's a question of, okay, when you compare your wealth or money or the concept of money as a store of value versus other markets. If you were living in London, okay, my 50 million is $100,000 today. In 10 years' time, is my 50 million still $100,000? Those are the real concerns that you should be having. But whether your pension funds are at risk, they are not at risk. I mean, if it's Nigeria borrowing from them, it's okay. What's the worst that will happen? They'll print more Naira and they'll return the money back to the pension funds. So I don't think that that's a problem. I think it's just a question of, are they doing the best? Would it be the best investment for me as a pensioner? in terms of when you're retiring, maybe in 10 or 20 years time, how much value has been created or destroyed? That's the real question. So that's kind of like how I like to look at it.
Oh, okay. Thank you very much, Mr. Oluche. Okay, Ahmed, could you please respond to the question asked earlier? What other risks are likely to impact global growth this year? Ahmed.
Sorry, can you hear me now?
Yes, Ahmed, we can hear you.
So
go on.
I was saying that the COVID-19 pandemic remains a major risk for global growth, even in 2022. The virus is mutating because of disparity in vaccination across different regions of the world. And as long as that remains, there's a chance that we could end up with a strain that would require another round of lockdowns across different economies, and of course with varying degrees, given our experience. So that remains a major risk for growth in 2022. And then we are now seeing a state of geopolitical tensions. You're seeing it in Europe. There's the Ukraine, Russia / the euro area, and you're having different flashes of that across different places. The hope is that it doesn't escalate beyond that, because if it does, we never know how that will disrupt the global supply chain. And then majorly, you look at China, which is expected to contribute significantly to global growth this year. They're just coming out of lockdown in certain key regions that are like the manufacturing workbench for the global economy. So these are some of the things that I think we should all be tracking ahead of 2022. I think the waste, depending on how they evolve in the next 11 months or thereabouts, I think they will be deciding how the global economy performs this year.
All right, Ahmed, thank you for that. So we'll go on to ask about 4 more questions. So I have a question from Razak Fatai. Dr. Franklin Ugu, please, I would like you to respond to this question. So the question is, so we've heard about the fuel subsidy removal. What impact should we expect, and would Dangote Refinery, which is set to be operational by September, have any impact on our FX management challenges?
Okay, thank you very much. Before I answer that, let me also mention, with regards to the global risk that we're going to face, that cyber attacks is also a major global risk that we're going to face in 2022, because it's increasing and it's going to affect, and interestingly, Nigeria is a target country. So Nigeria is listed as one of the target countries for cyber attacks. So we're going to experience more global cyber attacks as well. And also the issue of climate change is also increasing. Of course, we've seen the way the weather is changing. So these are, but with regards to your question, with regards to the fuel subsidy, of course, Dangote Refinery we are hoping and praying that it will come on stream maybe from the end of, maybe the end of third quarter. That's around August, September. And even I think 2 days ago, they said that maybe they will start with about 450,000. So invariably, when it comes on stream, it's a 650,000 liters. So if it comes on stream, definitely it will positively impact on our FX situation. In the sense, number one, we will not be looking for FX to pay at least for the transportation, for logistics and all that. If you decide to sell the refined petroleum to us in dollars, of course, we have to pay. If we decide to sell it in Naira, that's fine. But of course, there's some components of the refinery that will require Naira. Some components will require dollars. So it might be an arrangement whereby we can pay some in Naira, we can pay some in dollars in terms of what we are going to be consuming. But definitely, it will be it will have very, very positive impact on our FX demand. It means that the cost or the volume of what we require will definitely reduce. And it also means Now, as I said earlier on, the logistics, which we of course, when you import fuel from outside Nigeria, you pay for the ship that will bring it. You pay for the other expenses, all in dollars. All this will now be removed if Dangote comes on stream. And interestingly as well, if he now supplies to other African countries, he is going to sell in dollars. And when he sells in dollars, that foreign exchange will also come into Nigeria, which will also increase the supply of foreign exchange that we have as a country in Nigeria. So in summary, it's going to be a very, very positive development to Nigeria. And of course, there will also be other, spillover effects from the refinery. Other industries will also come on board, which means that if they also export some of the things that they're going to get from the byproduct of petroleum, they will also earn dollars as well. And of course, that means that in our assessment, it will be a very positive development in Nigeria. Thank you.
All right, thank you, Dr. Franklin Uku. So we have a question from Julius Okaifo, and I'll pose this question to our in-house panelists, the research team. So, Shehu, Ahmed, or Kelechi, any one of you can take this question. What are the implications for the stock market in Nigeria now that the CBN, through the monetary policy rate, has kept the interest rates has maintained the interest rates?
Okay. Thanks, Kasi. I think the first way to look at it is, what does that decision, what does it hold for fixed income rates or fixed income yields? Sorry. I mean, the fact that they're staying neutral means that, and to be honest, the first thing to say is maybe not much. It doesn't have significant impact because just like Mr. Lucia was saying earlier, there's been a breakdown in some structural relationships in terms of markets and macros. The GMO, the CBN, I mean, together have found a way to influence the yield in the fixed income markets without necessarily tampering with the monetary policy rate. The whole of last year it was flat, and during that period we had times when yields went up and they came down. So I mean, so in terms of that, normally when yields go up, you would expect that to affect the equities performance negatively. We won't see that with this, but it does not really mean that yields might not go up anyway without touching the NPR, even though for now it seems unlikely given their borrowing needs and considerations and all that. I think what we can expect for the equities market then are what are the things that will drive the market, and that's what we should be focusing on. And in that respect, we're looking at fixed income yields for now. It doesn't, I mean, increasing it doesn't look likely, which is a positive for the market. How will corporate perform in terms of earnings performance? It looks impressive in a high inflation environment. For a lot of manufacturing firms, they're able to increase prices and deliver higher earnings. So that's another thing that will help the equities market performance. So let's focus on what the NPR is doing for stock performance and more on the actual drivers of the equities market performance. I think is what we should focus on for now. I think it's lining up well for the equities performance. The risks is mainly in terms of how yields evolve in the fixed income market. So I think that's what we should really be looking at, rather than if left the NPR unchanged, doesn't mean that equities will now underperform or outperform. So let's take our cues from the fundamental drivers of that market instead.
Oh, all right. So Ahmed, for those of us looking to make more money from the money we have, what stocks? Yes, we all want to make money. So what stocks would you recommend in the equity markets? What stocks do you think people should look out for?
So I'm not going to give specific stock recommendation. In our report, we have a strategic portfolio that we feel people should use, and criteria around that as well. I will not give a specific stock recommendation on this platform. But beyond that, I think for the market, based on all that we've said around the economy and our expectations for that, You have to look at, the banking stocks remain top picks. Manufacturing, that's consumer goods now. These are resilient sectors of the economy, and because high inflation environment, they tend to also, perform very well because they're able to take prices and, to boost performance. So you also look at stocks in that sector as well. Also, across the other sectors, we're also looking at quality, fundamentally, how sound is the business? Does it have a competitive advantage in the sector? So these are the kind of stocks that we are going with. I won't mention names there, but more details are in the report.
Okay, Ahmed, thank you for that. I hope we've all filled the form in the link from the chat box, sorry. Okay, so I have one more question before we have the closing remark, and I would like all the panelists to give their insights. So my question is, how would you advise investors to navigate their investment journey in 2022, given the outlook for the economy? So I'll start with Mr. Olusheye Olushoga.
I think that there'll be a lot of opportunities. If it was me and I wasn't a finance person, I would say buy what you use, which is what I always say to people. So I'll be bullish on telcos. I think that the telco stocks have potential upside, regardless of whatever is going on in the environment right now in the long run. Particularly with the telcos, most of them potentially getting their PSP licenses and being able to start operating. I think that I will pick them over the financial stocks every day because I think they have a captive market. So telcos, top of my list. If you can get some cement stocks, whether it's Boa or Dangote, I'll say get some of those just simply because the government keeps trying to get some infrastructure done. And a lot of people are lobbying for a lot more roads to be done with cement. So I know that they have a steady supply of money, and I think that government policy also favors them. So I would say that. And then I would look at, I kind of like the new Boa foods just because they produce things that people would eat. So for me, it's more or less like fast-moving consumer goods, so the likes of flour mills, at the top of my list as well. So that's kind of like how I look at it. Telcos, number one, FMCG, number two. Leave all these Euro bonds and local bonds, leave them out of your focus for now and focus on the things that you can see, because those ones, there's going to be a lot of volatility, and the big people like Cassandra, the ones that will be making all the money, we retail guys, we just be there, counting our pennies. So that's kind of like my own position. So I'll be overweight equities, mostly in telcos, FMCG, and the industrials. Thank you.
All right, thank you, Mr. Shea. Dr. Franklin Ugo, please, you can go next.
Okay, thank you very much. In addition to what Shea mentioned, of course, we've already identified the good drivers, the sectors that will drive the growth, including telecommunications, financial services, construction, manufacturing, agriculture. It means that firms operating in these sectors will expectedly do well, or will expectedly achieve good profits. And so it means that if you have money and you want to invest, these are the areas we can look into. But it's also, there's also something that we have to bear in mind. There are so many opportunities in Nigeria, so many, and these are scattered in almost all sectors that we have. So it depends on if you want to be very innovative or very creative, you can also rethink what you're doing in terms of what you want to do with your money. But if you are risk averse, you don't take any risk, you just want to invest, and at the end of the year, you get dividend or you get return on your investment, of course, you can buy this, go into equity purchase and all that. But if you are a bit risk loving and you're adventurous or you want to achieve higher return, there are so many opportunities in all sectors, from the health sector to IT, to transport, to production. So there are so many things that you can do. So left for me, I will say that it depends on your own investment disposition and your own innovative or creativity that will determine how you want to use your money to achieve better returns. So that's my own advice tonight, particularly to Nigerian youths. I will say there are so many things that they can do. There are so many areas they can go into. I was talking to a young guy about 2 days ago, and he said that what he wants to do this year is to sell herbs that cure different things. And there's a journal, published, reputable journal, identifying so many herbs in Nigeria that people are not aware of and people are not using, that are curing so many things. I say he has actually started, and what he's seeing is very, very, very encouraging. So he wants to go into it. So in essence, what I'm trying to say that you can go into so many things. Real estate is there. The returns are, it depends on how you play in that market. It's also very, very good. So Nigerians, be innovative, be creative, and based on your investment disposition, you can go into so many things and achieve a better outcome. Thank you.
Thank you, Dr. Uko. Ahmed, you can go next, please.
Okay, I'll start where you left off. How you navigate the market should be dependent on your risk profile, like you said. So depending on how aggressive.
I think Ahmed is having technical.
Sorry, can you hear me?
Yes, we can
How
hear
is it
you.
now?
We can hear you.
Okay, thank you. All right, so I think for me, how you do it should depend on what your risk profile is, whether you're risk averse or neutral or you're aggressive, and that really should dictate the kind of asset classes and how you are weighting your allocation into the respective asset classes. Regardless of that, in terms of so just to pick which asset classes do I think that investors should be looking at, we are in a high inflationary environment, and under that, equities remain the asset of choice. In the fixed income space, we are seeing a managed pricing environment, so not a lot to go with there in terms of the public instruments. There are more opportunities in the private debt market in terms of higher yielding instruments. There's also a lot of structured transaction, which some of these might not be available to retail yet because of regulatory considerations, but that's another way that I think we can beat around it. So really overweight on equities now. This is where I agree with Mr. Olusheye because of the inflationary environment. But unlike him, I'm not just going to stay away from fixed income. I think that depending on, it's going to be a dynamic market. It's going to be a lot of noise really, and you should expect to rebalance the portfolio a few times before the year runs out, in line with how the market is developing. The central bank and monetary policy direction suggests that they will probably not tighten for now, but you never know what will happen or what kind of shocks will come to the system and might require a different approach. So, I'll be making my portfolio very dynamic in line with how the markets are shaping.
Okay, thank you, Ahmed. So, a dynamic portfolio, according to Ahmed. Cheryl, can you give your opinion?
Okay, all right. Thank you, Cassandra. For obvious reasons, I share, especially as it has to do with how we should navigate the markets in 2022. I share Ahmed's view, but I think I should also highlight probably one area that we're not speaking so much about, which is commodities, right? And for obvious reasons, we know why people are shying away from that space, but I don't think we can take it away that there is some value that we can milk from that sector. Also, we know that a lot of work has to be done around regulation and providing infrastructure for that space to try. I think it's one area we should also look into as well.
All right. Thank you, Sean. Commodities. All right. Kelechi, could you please give your advice?
Okay, yeah, based on what everyone has said, Sheil mentioned commodities. One well, I say area of commodities. I mean, people will see that the market is really not liquid in that space. But then from what we've seen so far, the returns in commodities is actually way higher than what we've even seen in the equities market. But I mean, looking at the growth trajectory we have said for different sectors, I agree with Dr. Ungu when he talked about telcos, which is by at this point in time. I also see the oil and gas stocks too. I think there's a little bit of spread that I want to get in that sector. And let us also not leave out the banking sector. When we look at yield a return on some of these banking stocks, we see them having really high yields. So if you're in for let's say high dividend, I mean looking at the banking side, that provides let's say room for potential gains. So for me, the equities market is a good place to start with, especially now. I mean, we have so many young folks who are pushing their funds to the global market, but now that with the global side, it's kind of like crashing. I think it is a good time for some of them to move, return back to the domestic market because there's room for potential gains here. So that's my.
All right, thank you very much. Thank you, everyone. So traditional assets, equities, fixed income, a bit of commodities, then real estate. So those are the investment vehicles we could all invest in according to your risk appetites and capabilities. So I'll call on Sahid Bashir, the Managing Director of Maritime Stockbrokers, to give his closing remarks.
Thank you, Cassandra. Yeah, good afternoon, Cassandra. Good afternoon, everyone. Thank you, Cassandra, for the job well done. My special thanks to our audience who have been with us since the beginning to this particular moment. Special thanks to my own faculty member, Lagos Business School, Director of Sustainability Center, Lagos Business School, Dr. Ungu, for his insight, invaluable insight he has shared with us on this platform today. We appreciate your time and your insights. Thanks for honoring our invitation and sharing your insight with our audience, most of whom are our clients. We really appreciate. Thank you so much for your time, Doctor. And also, of course, share. Part of us is a big player in the market, in the financial market. We appreciate you. Thanks to your time and your invaluable insight you have shared with our audience. That is quite insightful. Really appreciate your time and your contribution. And to the audience, our research team who has worked tirelessly to get us outlook for 2022. We appreciate your contribution and for giving us this insight and giving us the direction where we must go through for our investment in 2022. Thanks for heads up. And of course, this has been done in line with our value as a firm. We have a promise. Our promise as in Meristem is that we are a firm that gives up-to-date market information to our clients with a view to growing their wealth in good time in an atmosphere of transparency. So sessions like this is meant to, we are living that promise by preparing our clients and the entire investing public for what lies ahead in 2022. We've shared insights on the economy, on the macros, on the public policies, on the markets, fixed income markets. Shares talked about is quite bullish. He says we should actually buy what we use, and has advised our audience that we should be. He's very bullish on telcos, on construction, and a few other sectors. Likewise, Doctor has told us that he's taking a bet on a few sectors: financials, agri, manufacturing, real estate, construction, as well as telecoms. And of course, he advised us to be very innovative, very creative in terms of looking at other alternative assets, other non-regular sectors that we can look for value for investing public. And of course, our research team, they have told us, the team has told us that they are very bullish on equities. And given the fact that inflation environment is quite high, so you cannot ignore equity. They are very overweight on equity, and we should also pay attention to commodities. We promise that we would continue to give you up-to-date market information with a view to assisting you in taking informed investment decision in 2022. Our intent is to be your partners in growing your wealth and preserving the wealth, so to speak. We thank you for your time, for being part of our 2022 market and economic outlook presentation. We are enjoying to look out for more. And we continue to partner with you to ensure that you make best informed investment decision in 2022. Thank you very much for your time. Thank you.
Thank you very much, Bash. Thank you to our guest panelists and our in-house panelists. Thank you for everyone who joined. We hope to see you all next year too for this session. Let's all have a wonderful day and a wonderful week. Bye, everyone.
Thank you. Bye. Bye, everyone. Thank you for having us.
You've reached the stars, now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem. Let's grow wealth for you.
You've reached the stars, now let's see you conquer galaxies.
The beauty of wealth lies in growing, preserving, and transferring it. Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, the art of building wealth is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem.
Yes, I just paid my children's school fees. Supposed to buy some shares today, but it's school fees season, you know.
But just like school fees, stocks cannot wait. Life's many responsibilities come with its sacrifices, but with the margin lending facility, you don't have to miss out on your investment opportunities. Now you can buy shares even when you are not liquid. All you need to do is have existing shares, managed funds, or cash to be used as collateral. The marginable stocks will be calculated to determine how much you can get to buy new stocks. Remember, there is no investment without risk. The time and stocks wait for no one. Don't imagine what can be. Let the Meristem Margin Lending help boost your investment portfolio. Terms and conditions apply. Call 0700 Meristem now to get started. Meristem, let's take you further.
When it comes to making great investment decisions, everyone needs a buddy. Now you have one. Introducing Wealth Buddy, the go-to app where you can save, invest, and pay your bills. Now you have a buddy to help you reach your money goals, uncover attractive investment opportunities, and make payments with the press of a button. Here's how it works. Saving on the Wealth Buddy app is super easy. First, ensure you are logged into the app on your mobile device. Then head over to your savings dashboard. Click on the plus sign to see a list of savings options to choose from. Add your goal details and start date. You can also add a photo to personalize your goal. Choose to fund your savings plan from your debit card, and then you're all set. There are several options to choose from when you invest with the Wealth Buddy app. Head over to the investment dashboard. Click on the Add Investment button. Select on the Create Investment option. Choose an investment option from the list. Read all the information, then click Invest at the bottom. Fill in the required information. You can also add a photo to personalize your investment. Choose to fund your savings from your debit card or your wallet, and then you're all set. You can also pay your bills conveniently directly from the Wealth Buddy app. Go to the wallet dashboard and select one of the bill's payment options. Pick a bill you want to pay from the drop-down. Fill the relevant details and choose to pay with either your debit card or your wallet. And just like that, you're all set. Start your journey with your new buddy. Download the Wealth Buddy app on all iOS and Android devices today.